All right, guys. I hope we are live and good to go. I'm audible and visible to everyone. All right. So I welcome all to the session of Finance Decoded by Divyanshu Best, who is your host, your mentor, and your best friend for finance and management. And I welcome you all to Oliveboard channel as well. So guys, before we start the session, I would like to tell you that if you guys are preparing for the SEBI Grade A examination, then we have launched our exclusive paid batch for this particular examination, in which we will be gathering all your problems. We will be solving all your difficulties that you're having in preparation. So it's a one-stop solution where you can find the not only the study material but also the live lectures. Apart from that, you will also get uh, our expert advices on descriptive writing answers, our mock test, and the current affairs capsule as well. So definitely go and check out our SEBI Grade A 2024 paid batch as well. So today's session is going to revolve around the newses from the two regulatory bodies and circulars that we have from RBI as well as from our insurance regulator. Okay. So without any further ado, let's begin the session. And again, I'm telling you that you can download the PDFs of all these sessions on YouTube from our Oliveboard application. So download the Oliveboard application to get these PDFs in your devices. Okay. So beginning with the very first news, guys, that we have right now, it's going to be very important from the perspective of your examination, that RBI has relaxed investment rules for banks and NBFCs in AIFs, which is alternative investment funds. Okay, now this might be a little bit trickier for you to understand, and even if you read the circular, it's kind of tricky to understand that what are the parties involved, what was the historical background, what is going to be initiated, okay, what was happening since 2023, and how this is going to benefit the banks and the NBFCs and also the economy. And RBI has made a very smart move because as we say, nothing is hidden from RBI. Okay, RBI has a very close look on all the loopholes that the banks and the NBFCs try to figure out, but nobody can outsmart the RBI. And for that, actually, the RBI has made a very easier norms for the banks and the NBFCs for their bad loans. So, the Reserve Bank of India has relaxed its regulations on investment in alternative investment funds by banks and non-banking financial companies. Now, before we understand the whole circular, it's important that we understand how the parties are involved in this whole transaction. For that, we'll have to understand the alternative investment funds. The alternative investment funds are basically, very much similar to a basket of funds in which the banks can invest their money upon, and this fund will be invested further into various types of equities and various types of debt instruments. So AIFs are managed by professionals who invest this money in a variety of things that aren't typically found in a regular investment account. Okay, so for example, investing in a company, this could include things like real estate, startups, or even commodities like oil and gold. Okay, now that is a primary example of an alternative investment fund. But for the nature of this circular, we have to understand that the banks were actually using this alternative investment fund in order to hide their bad loans, in order to hide those loans which were not able to be recovered from the debtors. How? Let me try to make this more simpler for you. Okay, just I'll just open a blank slide for you to make it much easier for you. Fine. Come on, let's try to understand this here. How the whole operations work. Let's say that there is an NBFC or there is this bank. Okay. This is a bank. Let's say this is XYZ Bank. There is a company. Let's say the company's name is ABC Company, ABC Limited. All right. Now, what was actually happening that, for example, if ABC Limited had taken a loan from this XYZ Bank, okay, there was a loan transaction between XYZ Limited and ABC Limited. All right. Now, eventually, XYZ realized that this loan is going to be a bad loan. It's going to be a bad loan. The money is not going to be recovered by the ABC Limited. So, in order to create a nice picture of its financial statements, what XYZ will do, that it will delist, it will remove the name of ABC Limited. It will remove the name of ABC Limited from the list of its debtors, or from the list of its lenders, or I should say borrowers in this case, and they will show that this particular money has been further invested into an alternative investment fund scheme, which is a basket of multiple funds. All right, this was the whole picture which was happening previously. In order to remove, and in order to, this is known as evergreening, in order to remove the bad loans from your list of debtors, what the bank was doing was investing that bad loan, or was showing that the investment has been done of that bad loan into an alternative investment fund. Now, what was happening? This alternative investment fund was investing into multiple enterprises and multiple securities and multiple companies, including this company, which is a debtor of your XYZ Limited. Are you getting my point? What was the whole scam all about? The bank is trying to delist or remove the name of the debtor from its list of borrowers, in order to create a very clearer picture, in order to remove its bad loans, its NPAs. And on the other hand, this money that was shown as an investment in the alternative investment fund was invested in multiple entities, in multiple companies, including the company which is the debtor of the bank which we are talking about. Now, RBI found out about this. RBI said, okay, this is not going to work. You will become smart, we will become smarter enough. Okay. So what RBI said in 2023, RBI said that, okay, if you are investing in any alternative investment fund, and of that fund, if the amounts are being invested into your debtor companies, meaning there would be other companies also, for example, PQR Limited, there is, DAB Limited, okay, there can be your BFR Limited. So let's assume that all these companies are the debtors, are the borrowers of this XYZ Limited bank. So what RBI said a very simple thing, that all the money that is being invested in your alternative investment fund, and out of that, the money which is being invested, for example, ABC Limited is actually a borrower for XYZ Limited, and let's say DAB is also a borrower from XYZ Limited, but DAB is a good debtor, or it is a good loan. The loan is going to be recovered. But RBI said no, because you are trying to outsmart us. So whatever amount is invested in your bad loan or in your good loan, it will have to be liquidated within 30 days of investment, or you will have to create 100% provision, meaning the equal amount of provision will have to be created of the money that has been invested out of this alternative investment fund into your customer companies, or into your debtor companies. Are you able to understand this, guys? How the whole scam was being operational, and what is the modus operandi for this operation, and how RBI countered to this problem by making banks to create 100% provision, which is a very big task, because in this scenario, now what is happening in this scenario, even if your alternative investment fund was invested in a good loan company, then also you were going to create a provision of 100% amount equal to the investment as a backup if the investment goes bad. Okay, that was the whole picture by or after 2023, when the circulations came, and it was happening before. The role of RBI is into this in 2023, but this was happening even before that. So this was the whole picture. Now RBI realized that, okay, this is a very bad hardship on these banks, and even the banks will not be feeling very much confident in representing their bad loans. So let's do one thing, let's ease the norm for them. So what has been happened since then, or by this particular circulation, what changes will be addressed now? Relief for the lenders. RBI has relaxed its regulations on investment on alternative investment funds by banks and non-banking financial companies. How? Let's try to understand that. Addressing evergreening. They know that there is this kind of a default which is being happening by the banks. So this is a kind of a necessary evil which RBI has also admitted that okay, this is happening in the market, we know about this already. You do that. But we are relaxing the norms for you in order to represent the bad loans in your list of debtors. So the previous rules aimed to prevent banks from hiding bad loans by transferring them to AIFS, and this process was known as evergreening. So previously, to hide or to prevent the banks from hiding their bank loan or bad loans, RBI said that either 30 days or within 30 days liquidate all the investment which have been done in your debtor companies, or you have to create 100% provision of the amount which has been invested in the debtor companies. I hope you are able to understand what actually is happening here. Okay, now reducing provision. Now what is the current scenario? They have said that now banks and NBFCs only need to set aside provisions for the portion of the AIF investment that goes towards existing borrowers, debtor companies, not the entire investment. Okay, so now they are saying that you don't have to put the money in, or you don't have to create the provisions for the bad and the good loan both. Rather, you just create the provision that has been invested in the bad debtor only. Okay, so previously it was for the bad debtor as well as the good debtor. So kindly avoid this, not the entire investment. This basically is saying that you have to just create the provisions for the investment which have been done in the bad loan debtor company, which our example was XYZ company. And for the PQR company, there is no need to create a provision for that if that is a good loan. Focus on debt exposure. This changes or considers only that AIF debt investment in the borrower, not the equity holdings. One more thing, the alternative investment funds, as I told you, it invests in multiple companies and in multiple entities in form of debt and equities. So this particular provision is only regarded the debt investment, not the equity investment. So if any fund has been invested in the equity part of the debtor company, then that is excluded from these provisions. Only we are talking about the debt investment which have been done out of the alternative investment funds. The next thing, I have an example for you that if bank has invested 100 crore in an AIF but only 10 crores have been invested in the borrower companies, provision is regarded or will be made only for the 10 CR, not for the whole investment. Okay, so that's the example which you can understand from this whole provision. Now intermediary exceptions. Now there is an exception for this, very important, that if you are not doing the investment directly but doing indirectly with the help of hedge funds or mutual funds, then for that this is not a subject to these restrictions. Meaning, if the banks or the NBFCs have not directly invested in the alternative investment funds, but rather they have invested in a mutual fund which is eventually going to invest in the alternative investment funds, then that is an exception. For that there is an exception, so you don't have to create any provision, or you don't even have to do liquidate your investments in that particular scenario. So this is a very important news from the RBI that we are looking into regarding the relaxations for the banks and the NBFCs, how the previous scenario was there, how the provisioning was done, what is evergreening. We got to know all these things from this particular circular. Moving on to the next part of the session, which is the insurance regulator, which is IRDAI. It has retained LIC, GIC and New India Insurance Company as DSIIS. So what are these companies? We'll try to understand that. State-owned Life Insurance Corporation of India, General Insurance Corporation of India and New India Insurance Company, they have been given the title and they remain as the domestic systematically important insurers, DSII, and hence subjected to enhanced regulatory supervision according to the insurance regulator IRDAI. So basically these are going to be the insurers which are too big to fail, and because they are too big to fail, so they have to be regulated even with more concentration. That's what have been said by the IRDAI. So let's first understand the concept of domestic systematically important insurers. This abbreviation is also really important for the examination point of view. These are large insurance companies which are critical to the financial system's stability. Means if they are disrupted, the whole economy or the whole insurance sector will be disrupted. Their failure will disrupt the insurance services and the economy. And right now, three of the insurers, which is LIC, GIC and New India Insurance Company, hold the title of domestic systematically important insurers. Okay. Now we have the enhanced regulatory supervision. So why these will be supervised even more? They will face stricter regulations due to systematic risk. We have discussed earlier. This aims to improve corporate governance. So how the internal management of these insurance are done, that will also be taken care of. That will be considered as a priority, and its improvement will be also the necessity of the regulator. Then identify the manage and risk effectively and prevent future distress. So as I've discussed earlier, these are too big to fail. So they will be regulated with more cautious, with more focus, so that the risk is being effectively managed. Because as you know, if they disrupt, then the whole insurance sector will be disrupted. So I hope you're getting the gist out of it, that why is it important and why the title actually brings a greater responsibility. So as we say, with great powers comes great responsibility. That's a perfect example for this. Okay. Now I have a few questions for you regarding these two set of data that we understood today regarding the IRDAI and as well as the RBI. So let's see that how many of you are able to solve this question MCQ. Before the RBI's rule change, what did banks have to do with their entire investment in an IF if even a small part of the alternative investment fund was invested in a company the bank had lent money to, or known as debtor company? So previously in December or in this year, December in 2023, what was the previous protocol? Sell the entire alternate investment fund, disclose the bad loan publicly, set aside extra money, provision for the entire alternative investment, or do nothing about it. So see guys, previously it was considered that you either have to liquidate the whole investment, but within 30 days. Okay, so that is within 30 days is the part which is missing in this particular scenario. Okay, but yes, disclose the bad loan publicly, set aside extra money, provision for the entire alternative investment fund, and do nothing. So yeah, sell the entire alternative investment fund wouldn't be the appropriate answer, but yes, if we also include that within 30 days, so that would be the more appropriate answer for this question. Then we have another question. What does DSII stand for in the context of insurance companies in India? So I need not answer this question. You can solve that and give the answer in the comment section. Then we have other questions as well as for you. So question number 2, 3 and 4. You can solve this on your own and comment down the answers in the comment section as well. Okay. Again, I'm telling you guys, we have launched our SEBI Grade A 2024 course already. The classes are live and you can avail the courses and avail the classes and in a recorded format as well. So need not worry of the classes which have been covered already. You will still get the classes in the recorded format and the live classes as well. So it's time to shine, guys. It's time to, just take the action rather than thinking, and just go ahead and enroll to the paid batches as well. Okay. So that's all from my side. This was me, Divyanshu, your host, your mentor, and your best friend for finances and management. And I will see you guys with the same concepts and new information from the world of finance in the next session of Finance Decoded. Till then, take care, goodbye, and Jai Hind, guys.